When the markets closed today, the S&P was down 12 basis points, with the Dow Jones up 11 basis points, just off our all-time highs. And with me today on our podcast, I have my friend Adam Schmidt. Moving into our first story of the day, we see these massive public pensions are moving heavily into U.S. equities. Public pensions now hold a median 47.3% of their assets in U.S. equities at the end of the third quarter. This is according to Wilshire Trust Universe Comparison Service, and that is more than they've had since 2007 and up 44.1% from a year earlier. Now, a lot of times what we're seeing with these pensions is that they have to move heavily into equities to chase the 7.5% yield that they need to be able to pay out their obligations to retirees in the future. A lot of this is due to the Fed artificially keeping interest rates low. The pensions from the 1950s and 1960s were set up in a way that they would be able to invest in risk-free assets in corporate bonds that would earn them positive rates of return, typically in the range of 3 to 6%. And then they would invest a small portion of their assets in U.S. equities to maintain the 7% yield. But what we've seen in recent years is with the Fed keeping interest rates so low, these big pension plans are forced to enter into these heavy equity asset allocation portfolios. And what has happened is this has led to a heavy hand of unfunded government pensions. Now, a lot of people might say, but this doesn't matter. Even if the pensions can't go bankrupt. Well, this is truly not the case, and we saw this with Detroit a few years ago when they declared bankruptcy. A lot of the people with government pensions are not getting paid. And so this poses a major threat to the world in moving forward. The government has approximately $5 trillion in unfunded pension liabilities, and none of these pensions are sound. As I'm looking through, Colorado, their state pension is 60% funded. California is 73% funded. Alabama, 66%. Texas, 81%. In fact, there is actually only one state that has a 100% funded government pension, and that is South Dakota, probably the most meaningless state for government pensions. So what does this mean? Well, taking on more exposure to stocks is a heavily risky bet, especially as global economic growth is slowing and talk of a potential recession has grown louder. Personally, I think the recession is right around the corner. The Fed has kept these interest rates too low for too long, has inflated these massive asset bubbles, and these risks can translate to consequences in a decline. Big hits to pension funds, stock portfolios during the financial crisis were followed by a wave of benefit cuts for government workers hired since then. So what this is all leading up to is pensions throwing billions of dollars into U.S. equities, further driving up prices, further driving up asset bubbles. And if there were to be another 50% correction, like what happened during the Great Recession, there's no way these public pensions are going to be ever have the capability to pay anyone out. They're already severely underfunded. The only way to keep this funding going up is either to raise taxes, which no one's going to vote for. So this is something to keep a major eye on moving forward. The public pensions move the public markets. And then our next story now is Peloton's revenue had a pretty good day. Their revenue rose $228 million, up from $112 in a year ago, and their net losses shrunk to $49.8 million from a loss of $54.5 million a year earlier. However, Peloton's stock is still trading around $24 when their IPO price was $29. And Peloton has the second worst debut of a so-called unicorn stock, or a company with an offering size larger than $1 billion this year. The whole tech IPO market has been an absolute catastrophe. We've seen stocks like Chewy, SmileDirect, Uber, Lyft, all of these money-losing companies that are attracting massive amounts of capital, and they're blowing up market capitalization. They are essentially just losing money for investors. And what we've seen is that these IPOs, all they do is benefit the initial founders and investors in the company. And then what happens is they take these companies private, these investors who have had their capital locked up for 5 to 10 years, immediately cash out and sell their shares to some schmuck who buys it thinking that they're going to make more money on price appreciation. And then what they realize is these companies are never going to make money, so your asset has now just become nothing. So essentially you're just wiping market capitalization and wealth off the planet. Going off with Peloton, Uber, as I mentioned in my last podcast, is my favorite money-losing company who potentially will never turn a profit. Well, they actually reported their earnings today, and they reported a third quarter loss of $1.16 billion compared to $986 million in the same quarter a year ago. So what their losses are actually becoming bigger. And the majority of this loss, actually around $400 million of it, was due in stock-based compensation. Uber shares were down around 10% on the day, and revenue actually grew 30% year over year, while their losses are growing bigger. And this is sort of like I mentioned, Uber's providing a service for less than it actually costs to produce. So the more revenue that they're doing, the larger their losses will become. Ultimately, this has led to Uber losing more than $7 billion this year, and there's analysts are throwing questions at them in their earning calls. And my question is, who's going to keep giving Uber cash? They're losing this money. Their burn rate is through the roof. Their creditworthiness is terrible. They won't be able to raise any more money if they do another second equity. So I don't know where their money's going to keep coming from. Adam, do you want to talk about WeWork a little bit?
Yeah, so WeWork, let's see. So WeWork had a lot of investments from SoftBank, which they've been dumping over $9 billion into WeWork for the last couple years. And WeWork has been down a lot lately.
I think they actually lost almost $20 billion off their suggested IPO. They were supposed to IPO around $20 billion, and now they couldn't even take it public. And SoftBank has this $100 billion vision fund, which is designed to invest in startups. WeWork was one, Wag, the dog walking app, was one, but almost all of these investments have failed, notably failed.
Yeah, and you've really noticed that with the way that foreign investors have been talking to the CEO. The CEO of SoftBank was currently in Saudi Arabia for one of his meetings, and nobody actually showed up. Or if nobody did, a very few number of people actually showed up. And they lost, the Vision Fund actually lost $600 million due to Uber. Due to their recent earnings, and they actually had to buy 80% of WeWork for $9.5 billion. And this was after their previous investment of $10.65 billion. So it looks like WeWork is the Vision Fund is just struggling to actually maintain afloat due to their big investment in a failing company of WeWork.
Yeah, and I think a lot of the reason the Vision Fund is struggling so much is that the Federal Reserve, with keeping interest rates artificially low, SoftBank has been able to funnel cheap capital, cheap money into these money-losing companies, hoping that eventually they'll be able to make money off price speculation in the future. Mm-hmm. But there's no fundamentals to back any of these companies up. Not a single one of them has ever turned a profit, and none of them show any potential of ever potentially earning money.
Yeah, and even with SoftBank's investment of $10.5 or $9.8 billion, that really cut WeWork's overall valuation, I think, from $36 billion to $28 billion. So really cutting out a huge chunk of WeWork's valuation, and you can really see that with other CEOs and other investment banks really pushing earnings more now, and they're really pushing off away from unicorn or tech startup companies in the recent months.
Yeah, this reminds me of the late 90s, early 2000s with the internet stocks that blew up, where the NASDAQ lost 80% of its market cap within a few days. And I think we are in the process of seeing the exact same thing happen with these tech IPOs, where there one day is hundreds of billions of dollars in market capitalization, and then investors wake up and learn that there is no fundamentals behind any of these companies, and that market cap instantly drains away. And it's not just me saying this. We've actually seen Morgan Stanley predicting dismal returns the next decade. And they're saying with their traditional investor portfolio, which is a typical balanced portfolio of 60% stocks and 40% bonds, they're expecting that return to nominally return 4.1% over the next 10 years. That's nominal. That's not even real. We've already seen within the last week that inflation predictions for this next year are approaching 3%. So that means we are looking at, based on Morgan Stanley's prediction, 1% real returns on a balanced portfolio. And this is coming after, these low portfolio returns are coming after a decade of massive multiple expansions from stocks and a flood of money into fixed income, as central banks have just recklessly eased monetary policy to respark economic growth. But what I think this tells us is that government stimulus never actually creates the growth. Real growth comes from savings and investing and creating jobs with capital and lowering taxes. And over the last 10 years, the S&P has returned 13.8% annually. But once you take out inflation, you're looking at real returns hovering around 10%. And I don't trust the CPI that the government's producing. They've taken major areas out. They've taken housing out of the CPI. They've taken medical expenses out of the CPI. We're actually seeing people's health care premiums rising 30% this year. And that's not including the CPI. So the government is cherry picking their metrics that they want to keep in the CPI for inflation to hide the truth from consumers of just how bad inflation has gotten. And so what we're seeing is these valuations are becoming far more accurate in determining what the 5 to 10 year real outlook for an investor should be. No longer are we going to see these massive gains that we've seen over the past 10 years, especially with government policy and loose monetary stimulus.
Yeah, and with the Fed's current FMO statement that came out earlier today, they were saying that they cut rates to 1.5 to 1.75% for the Fed funds, and they're not going to hike up any more interest rates until they see interest rates around 2%. So
interest rates or inflation?
Inflation. Yeah, inflation around 2%. So if they're cherry picking a lot of the numbers that they're showing, what would stop them from cherry picking the inflation rate so they can hover below 2% so they don't have to hike up any more interest rates?
And I believe Jerome mentioned that they're going to target a 2% symmetrical inflation rate.
Yeah.
So over the last few years, with the numbers they've cherry-picked, they've shown inflation significantly less than 2%.
Mm-hmm.
And when Jerome was pressed on his 2% symmetrical target, I got the impression that we could see inflation of 3% before they would even consider raising rates. Not that they would do it, that maybe we'd have to get to 4 or 5% government-issued CPI numbers before they would actually raise interest rates. And by that point, we know they've cherry-picked the numbers so bad that in a real sense, that might be 10, 11% inflation once you take in housing and medical expenses,
mm-hmm.
which are two of the biggest areas that we've seen. Meanwhile, as we see the stocks in the S&P and Dow Jones reaching all-time highs, investors are just stockpiling cash
mm-hmm.
to the tune of, I think the latest numbers that we've seen are $3.4 trillion. And some people are saying that this is reassuring, that this can tells us that investors have more money to push this bull market further. Actually, how I look at this personally is saying investors have this money that they don't feel that they can get real relative valuations to put that cash to work. They would rather put that on the sidelines and wait for some of these asset classes to drop back to realistic prices and then deploy that capital and put it to work. Just throwing money at these high asset prices to have them drop in a year is not the best return on investment. And we've actually seen assets and money market funds growing by $1 trillion over the last 3 years to the highest level in around a decade. And economists are blaming this on a variety of factors, claiming higher money market rates. For a long time, those rates were at 0%, with the Fed raising them up, and then eventually lowering them back down. Yet some analysts are saying that these large cash, there's huge stockpiles of cash, shows that investors haven't grown excessively confident in these markets' double-digit gains, and that they just want to have the money on their side like 2007, 2008, when the stock market did crash 50% over that year and a half, that then they're going to come in and buy the dip. So I think personally that's what's happening too. I don't foresee this bull market continuing more than the next 6 to 12 months.
Mm-hmm.
Historically, we've seen every time except once, that the yield curve has inverted, there's been a recession within the next 6 to 12 months. And we saw that 2 and 10-year Treasury invert a couple months ago. So something to keep an eye on. And then moving on to our next thing, I was struck by this article I saw in the Wall Street Journal today. It was talking about Elizabeth Warren and JFK and just how differentiated the Democratic Party has come in a mere 60 years. I remember when JFK said, "Ask not what your country can do for you, ask what you can do for your country." Well, meanwhile, we have Elizabeth Warren out here saying, "Ask not what you can do for your country, but ask what your country can do for you." So this lead me down the road of thinking, what is the actual role of government? I believe, and the founding fathers would agree with me on this sentiment, the role of government is to protect the rights of life, liberty, and the pursuit of happiness, to enforce contracts and police rights, to maintain as small a presence as possible, to promote freedom, to promote free market capitalism, and then not be Santa Claus. I do not want my government giving out Santa Claus programs to everyone. And this just shows how radical the government or the Liberal Party has gotten within these past 50 to 60 years. JFK was one of the most popular Democratic president candidates in the history of the United States. And this is just 60 years ago when he was still saying, ask what you can do for your country. It's not about what your country can do for you. And Elizabeth Warren released her specific healthcare platform, Medicare for All, and she said that there would be no tax hikes on the middle class, that if you made less than $1 billion, or if you had a net worth of less than $1 billion, your taxes would not go up at all. Now, I seriously question some of these assumptions she's made in her plan, in that how is she going to do Medicare for All, a single-payer plan, without raising a single cent of taxes on the middle class? At least Bernie Sanders is honest when he says he's going to raise taxes on the middle class. I think she's lying to you. I think she is straight lying to your face, just pandering for votes. And then one of her other, do you have any comments on that healthcare plan?
Yeah, I think she's pandering as much as she can. She knows that she can't get, obviously, the more rich donors from the Democratic Party onto her side, so she's trying to be as wide as possible to make sure that she can get as many voters as possible. So when you want to do that, you want to target the middle class, because that's where most of the people are that are in America, or either in the middle class or a little upper middle class. Yeah. So she's just trying to pander as far as possible and as wide as possible, making sure that what she says is on point, that the everyday man wants to see more raised or higher taxes on everybody that's wealthier than them, but not specifically on them. And if you, we watched a video like last week about the effective tax rates over the past however many years, 60 years, I think. Yeah, and it was just showing no matter if taxes were raising or were falling, the effective tax rate on wealthy individuals stayed at 17%. So even if you're going to increase taxes on the wealthy, I don't really think it's necessarily going to improve any tax receipts that the government does get, or is going to actually pay for Medicare for all. It's just going to hover down around the 17% like we've seen constantly or historically over the past 60 years.
Yeah, and that actually reminds me of single-payer Medicare for all sounds awesome. I have a friend right now who's living in Germany, and Germany is a similar state of Medicare for all. And she said she went to set up an appointment with a doctor, and she had to wait until 2020 to get an appointment. She could not see a doctor for approximately 6 months. So that's something we have to talk about, is that a lot of the reasons that we have co-pays on our current insurance system is to prevent you from going to the doctor with the simplest cough, with with the smallest symptoms. It's a barrier to entry so that not everyone is running to the doctor anytime they have an ailment.
Mm-hmm.
That's part of the reason we have the copay. And you brought up the wealth taxes. And I mentioned this in my first podcast, that wealth taxes have never worked anywhere in the world that they've been tried. So I actually did some quick research on wealth taxes that were tried in Sweden and France. And here's how they went in Sweden. The Nordic country had a wealth tax for most of the 20th century, though its revenue never accounted for more than 0.4% of gross domestic product in the post-war era. One reason is that the levy treated different assets differently. This distorted investment as the wealthy took on debt to buy tax-free assets. If the U.S. farm lobby convinced President Warren to remove farmland as a taxable asset, prepare for a property bubble in that shift. I totally agree. I could see we already have these tax-free government bonds. We have real estate. We have certain farmland exemptions where the wealthy will simply move their assets and their investments into these tax-free asset classes to avoid the wealth tax.
Mm.
And then, again, this was tried in France. In 1982, Socialist President Francois Mitterrand imposed a wealth tax with a top rate of 1.5% on assets above $1.5 million at the time. The tax was eventually eliminated and reimposed several years later. In 2013, another socialist president, Francois Hollande, tried to hit the wealthy even harder. But what were the results? Some 70,000 millionaires have left France since 2000, according to the South African research group New World Health. Do you think that is healthy in the France economy to lose 70,000 millionaires, 70,000 people who have capital to hire people?
Mm-hmm. No, that's not. I mean, you might as well just tax them at a normal tax rate to keep them in there, keep them in France, rather than trying to raise the taxes on them. So you can get maybe a minuscule of more tax revenue per year, while making it a lot harder for them to either find deductions that they can have or a different asset classes that they can have. But if we see, in theory, a wealth tax is good, because in theory, the assumption is that everybody will pay their taxes. In real terms, it's not that way, because either people are going to leave the country or they're going to find new assets to move all their money into, either if it's government bonds, new property or real estate that are tax-free, or anything like that. So with France imposing that and seeing 70,000 millionaires leaving since 2000, so not even 20 years ago, it is really going to hurt the economy of France, just because they don't have those people to hire more workers to stimulate the economy even more.
Yeah, I think France would probably say we'd rather have 20% of something
mm-hmm.
than 70% of nothing.
Yes.
And meanwhile, Elizabeth Warren is saying realistically that her wealth tax is going to raise some $3.6 trillion in her first decade. And if anything, France's experience suggests that this is just loony,
mm-hmm.
unrealistic.
Is that with the assumption that everybody is going to pay their taxes and not move, leave, or find new ways to hide their wealth?
I believe so. And then, interestingly enough, in 2016, the French economists did some research on the wealth tax, and what they found is that imposing a wealth tax actually caused a net revenue loss. And we see this with the Laffer curve.
Mm-hmm.
You know, we have our point of at a tax rate, we have our maximum tax revenue. Most economists think it's somewhere around 25%.
Mm-hmm.
At any point that we increase tax rates above 25%, tax revenue actually goes down. And we've seen this historically, even with inflation-adjusted numbers, with corporate tax rates, marginal tax rates, capital gains tax rates. So these wealth taxes are not sustainable. And say just for sake that they do work. Well, once you've taken the wealth of the billionaires, there's no more money to have.
Mm-hmm.
It's not sustainable.
Mm-hmm.
Do you think anyone is going to improve their standard of living and just keep pushing to make that extra money, just have the government take it?
No, once you impose a wealth tax, and if it's actually and it actually works well enough to take the wealth away from the millionaires or the billionaires, then it's just going to make people more reliable on the government. They're going to stay at where they are or where they're at right now, or get even worse, so they can get more subsidies, more grants from the government, more assistance, so they can not really do anything. So they would get more Social Security or more food stamps rather than actually trying to improve their situation.
Yeah. Now, if we do, the biggest wealth tax that we actually have is inflation.
Mm-hmm.
So I was running the numbers the other day. If you have $1 million today, and you have 3% inflation for the next 100 years, that $1 million has the purchasing power of $47,000 today. We're talking about a 95% tax on your wealth.
Mm-hmm.
So I think that's personally where the government's going, is they see this, and they know that they can't directly tax your wealth. So what are they going to do? They're going to print so much money that they are going to create massive inflation, and that inflation is the way that they're going to tax their wealth. And this leads us into our next point, is the European Central Bank elected a new president, Christine Lagarde, and Bloomberg noted that she joins the institution at a key moment with the Eurozone economy again under stress and the European Central Bank putting increasing pressure on politicians to step up with fiscal measures and structural reforms. Well, if any central bank in the world has been worse than the United States, it's been the ECB. ECB has been terrible. And we've even seen Germany, the region's largest economy, facing criticism for continuing to run a budget surplus, watering down proposals such as a euro area fiscal capacity, and stemming progress towards a common deposit insurance. Now, Adam, don't get me started on FDIC insurance. That is the biggest system of moral hazard that we have in the United States, in my humble opinion. What the FDIC has done to the U.S. is created a system where Americans do not care where they put their cash.
Mm-hmm.
They will put it in a bank, knowing that if the bank is reckless with their money, that the government will bail them out up to $250,000 of their money. Now, we didn't used to have the FDIC in the United States. Banks used to have two separate functions. We would have banks that warehouse money, meaning they strictly kept your money and they'd provide checking services, and then we'd have bank loaning services, similar to what we have today with fractional reserve lending.
Mm-hmm.
And meanwhile, over time, once we instituted FDIC insurance, these two functions of banking merged into one. So now we don't have this separate warehousing. And we have Americans right now that will do more research on what TV they're going to buy, what car they're going to buy, heck, even what microwave they're going to buy, than where they put their entire life savings, knowing that if the bank loses that money, the government's just going to bail them out.
Yep.
So Peter Schiff, actually, I think he had a tweet that was right on. He said, the new head of the European Central Bank, Christine Lagarde, believes she can create jobs by destroying savings. But jobs come from savings. Jobs need capital, and capital investment is funded by savings. When you destroy savings, you also destroy jobs. All Lagarde will create is demand for #gold. Yeah, the ECB is even more extreme with their interest rates than the U.S. Central Bank, with the Federal Reserve. They actually want negative interest rates. And we have those Keynesian economists over in Europe that think government stimulus, low interest rates actually creates jobs. But in reality, what you need is higher interest rates to encourage people to save, to invest, so entrepreneurs and business owners can get the capital they need to invest in productive products. And then, at that point, that productive products, you can sell them to people, you can hire more people, you can invest more, you have more money to save, rather than just saying, no, we're going to have more economic stimulus, lower interest rates. So, do you think she's going to be a good pick for the ECB?
Based on everything that you're saying, I think she would be good just by the standards that the ECB are going right now. Is she good in
So by
general?
good, you mean bad?
Bad, yeah. Good, bad, because they're both terrible. But yeah, no, she just sounds terrible. And by the way that they're treating Germany by running a surplus is is crazy because you would want your economy to run a surplus.
Yeah.
Obviously. Because you're not adding to your national debt, you're not running a deficit, you're actually having more money to, you have more money to do than what you know what to do with. So I don't understand why they're going after Germany to actually try to run a deficit, which makes no sense when you look at fiscal monetary policy.
Yeah. Where I think this is going is Christine Lagarde is a big believer in modern monetary theory. Now, modern monetary theory, I believe, is the cancer for the developed world. And the thesis behind this theory is that sovereign countries like the U.S., the ECB, Japan, countries that have their own central bank, they're not constrained by revenues of taxes when it comes to federal government spending. So in other words, governments do not need taxes or borrowing for spending since they can print as much as they need because they are the monopoly issuers of the currency.
Mm-hmm.
This is, more than anything, this is theft.
Mm-hmm.
Because when you create money, you are, like we said earlier, you are taxing the wealth and the purchasing power of people that have saved and invested. And all you do when you print this money is just create inflation. And we want our Federal Reserve. We want our central banks. They're supposed to be independent of political pressure. We want them to hold our politicians accountable. If they are running government deficits every year, we do not want to reward them with low interest rates. We want higher interest rates. We want these politicians to feel the pain that they are going to have to service this debt in the future with higher interest rates on these government deficits. Imagine if the U.S. government, who has a debt of $23 trillion, had to service its debt at 4 or 5%. The pain that the politicians would feel. They wouldn't be able to spend their money on anything they wanted.
Mm-hmm.
All this does is it opens the printing press in the back of the Federal Reserve, and they're just spewing it out.
We can barely service our debt as it is right now, and we have like super low interest rates, right?
Yeah.
Yeah. So even if we would increase the interest rates, that would just make everything worse. So if we continue this level of spending that we have, so modern monetary theory is just basically we're gonna end up playing with monopoly money in the end.
Yes, we will end up with monopoly money, and we talk about our government debt of $23 trillion. Well, this is just government bonds.
Mm-hmm.
When we look at that, so what we're saying is our coupon rate, our debt service payment, is for a certain number of dollar bills, not a certain dollar of purchasing power with those dollar bills. So all the government has to do, we could theoretically have $200 trillion in debt, and all we have to do to service that is print the number of dollar bills needed to service those interest payments.
Mm-hmm.
So I think that's a nasty, slippery slope that we're coming with. It's a sneaky way to tax people without them directly feeling it in the moment. It's there. They will feel it over time. But people don't like paying taxes.
Mm-hmm.
So this is just a sneaky way for politicians to tax their constituents without them really knowing it.
Yeah, and the modern monetary theory really stems from fiat currency. So the U.S. currency is actually fiat currency. So what that means is we're not backed by any commodity. So we're not backed by gold, silver, copper, anything. So really, we can print as much money as we want, and it will just decrease the value of the dollar and rise inflation. But we can't go broke or insolvent because we're not backed by anything.
Mm-hmm. And we were backed by the gold standard until 1971 when Nixon took us off. And this is kind of the main problem I see with Bitcoin right now. A lot of people are all hype on it, but it's that same issue. Bitcoin is not backed by anything.
Yeah.
If Bitcoin were to be backed by a physical commodity, it could function like the US dollar once did and become the most dominant player in the space of money. But right now it's not backed by anything. A lot of the big moves, the volatility I see is people just looking for price speculation.
Yep.
So I think if some government, if some body, I was really looking towards Facebook Libra to do this, but they've looked like they're backing off. But if some body was able to issue a currency that was backed by a physical commodity like gold or silver and restore that purchasing power, I think that would be the most physically dominant currency in the world. everybody would want that in the reserves.
Yep.
So, moving on to our final things on a brighter note, we're going to go to things I like. So the first thing I like is that by all accounts, Lori Loughlin is reportedly anguished about the charges she's facing over her alleged involvement in the college admission scheme known as Operation Varsity Blues. And this just makes me so happy. You know, when she reported to court that first time, she was smiling, signing autographs, giving handshakes, taking pictures with people. And now she decided to plead not guilty to all her charges. And a lot of legal analysts are saying she might do some serious time. We saw Felicity Huffman. I think she only served 13 days, but she pleaded guilty and took all the steps necessary to have that lesser of a sentence. Well, Lori Loughlin is apparently in big poo-poo. She's in trouble, and she knows it. And so, but this whole Operation Varsity Blues scandals left me with a few big questions. So, with Lori Loughlin's daughters getting into USC, presumably that we know that they weren't qualified to get into the schools based on their SAT scores or their GPAs in high school. So if these kids weren't qualified to get into these elite schools, why aren't they failing out? Because presumably they're not qualified to be there, so they wouldn't be able to handle the curriculum at these institutions. So this is telling me that, one, either standardized testing isn't capturing the capability of the students, or B, the more realistic thing, I believe, is that these schools are watered down and too easy. And we've seen this with the degradation of the value of the college degree. It doesn't take a rocket scientist to get a liberal arts degree anymore. Schools have just become too easy. And then, finally, my last thing I like was the New York City Marathon was this past weekend, and the New York Times did one thing right for the first time in their life, and they had a cool piece on a runner called Guillermo Pineda Morales, also known as Memo. And Memo is in the top 10 marathon runners in the world for his age group. He's 46. Last year, I think his time in the marathon was 2 hours and 28 minutes, and they did a cool little op-ed on him, and they followed him around. And Memo believes in two things with exercise: hard work and never giving up. Now, this is so contrary to the American fitness industry with Peloton and some of those other services. And what we've seen is that the American fitness industry is worth approximately $30 billion. But all Memo does is he gets shoes and runs outside. And they even show him in the video, he's doing push-ups on park equipment. So you don't need to spend a ton of money to be one of the top 10 marathoners in the world for your age group. And it just lightened my day a little bit when I saw that. If you are paying a lot of money for a gym, you're probably getting suckered out. So, other than that, Adam, do you have anything that you want to say before we wrap it up?
I do not.
Do not?
Nope.
Well, thanks for joining us, and we'll see you next time.